Hi there, hustlers. Welcome back to another episode of the Hemlane Hustle. Today, we've got two guests who can save you enough on your taxes to buy that extra rental property, or at least wash out those hikes in your interest rates. Yes, they are that good. Joining me today is Amanda Hahn and Matt MacFarland, Managing Directors of the Keystone CPA. As CPAs and real estate investors themselves, they have helped countless real estate investors across the nation to supercharge their wealth building through proactive tax savings. They are the co-authors of the top-selling Amazon books, including the book on advanced tax strategies, and their teachings are on prominent publications such as Money Magazine, Google Talks, and CNBC. In this episode, you'll learn how to earn more from your rental properties without the IRS coming after you. Amanda and Matt, welcome to the show.
Thanks, Dana. Thanks for having us. Appreciate it.
Yeah, we're excited to be here.
Great. Well, my first question in your journey is, how the heck did you get started with helping and focusing on real estate investors? As CPAs, I'm sure you didn't start there. So what was that journey like, and why did you decide to focus on income generating real estate investments?
Actually, for me at least, my career did actually end up starting there. So
Okay.
I'm the third generation of real estate investors in my family. So my grandparents did real estate, my parents invested in real estate, but I was always taught to go to school, get a stable job, which for me, my mom said to become an accountant. And so I started working in one of the big four accounting firms, and I happened to be in the real estate specialty group. So I think my initial work experience in taxes was to work with real estate companies. And I guess at the time, I never thought I would invest in real estate. I was just a CPA who worked on real estate clients.
Yeah, and for me, I also worked at a big four accounting firm, and my aha moment was I was probably 2 or 3 years in, probably a tax senior, and I was reviewing somebody's return. And this individual, probably at that point in time, this is 20 plus years ago, right? At that point in time, he was probably in his 60s and retired, and the only thing on his tax return was rental properties. And you could quickly figure out that because of the depreciation expense he was taking, he was not paying any income taxes on his cash flow, but he was making over six figures in cash flow. I was like, oh, okay, that's when the light bulb went off. I was like, oh, there's something here, and so that's kind of, I don't know, it made sense. I liked it, and so I decided to kind of focus on what I did more on the real estate investors instead of big corporate America, for lack of a better term, right?
Yeah, probably much more fun because you get to meet a ton of different people from different backgrounds and get to know them personally as well. What are some of the biggest mistakes that you've seen with rental owners, and particularly around their taxes, tax reporting, and accounting?
I would say probably lack of accounting is a big one, real estate or just I think, people in general don't really like to talk about bookkeeping and all the record keeping stuff. And so that's one area, people just not understanding what they can write off and what they should be tracking. And so I think it's really important for investors of all levels, beginner to very experienced, to just kind of get an understanding of what are all the things that you can legitimately write off. Because I think we're really good about deducting mortgage interest, property taxes, and kind of the property specific things, but it's more of the overhead stuff, that people tend to miss out on, like going to a conference or driving, for real estate. Sometimes like software fees and educational fees are things that we see missed, pretty frequently.
I think for me too, the one thing that comes to my mind is people I think are innately, they don't understand taxes. They fear the IRS, whatever, the tax code, whatever you call it. And so I think by nature, people are reactive. So they're just used to, I do my taxes in March and April every year, and that's it. And I ask a question when I get my tax returns done and what have you, right? But so I think that's the mistake that investors make, is they need to kind of change that thought process to being more proactive and take more control of your situation and what you have going on and what your investment plans are. What are your goals from a short-term, long-term perspective? What are we trying to do from a tax savings perspective versus waiting to try and get your questions answered 12 months after the fact or after something happened.
Yeah, that's such a good point because everyone's in a different their life, they're at a different state in life. And so some may be looking to sell the property sooner and all of that, and that will obviously impact it. I think it's really interesting, Amanda, how you talk about the recording and of things that you can write off, because we see that as well. It's like, keep all these receipts, just document it at the time. And if you do that 2 seconds on your phone, with Hemlane, then it's just like, okay, great. You have all of this recorded. You remember what that dinner was for and who you had dinner with in case the IRS comes after you. And so really just making sure that you know what you can and can't write off, and then having a document trail is super important. I have another question for you because it has to do with accounting and cash flow. And it's a little bit off topic because it's a legal question, but I have to ask it. What type of legal entity do you think is best for landlords? And here is why I ask you that. We live in California, and there's obviously a franchise tax of $800 a year. You may say, hey, foreign qualifications, and maybe I don't need to pay in California because I operate my rental in Florida or Texas. You probably say you still need to pay your taxes in California, right, to be super safe. But, I hear a lot from lawyers. Lawyers are always going to tell you to take the safest route with any sort of liability and risk. There's also a school of thought of like, hey, you have landlord insurance for a reason. They should cover quite a bit of the liability associated with owning a rental property in your personal name. And so on the accounting side, not the legal side, but on the accounting side, how do you guys think about that and the entity structure that a real estate investor should have when they have one single family home versus, a 20-plex or 20 total units? How do you think about that from an accounting perspective and a tax perspective?
I think with anything in the investment world, it's a cost benefit decision that has to be made, right? So like you were saying, attorneys love to have the safest structure, which might be multiple LLCs, and California notoriously expensive for entities. We do have clients all over the US, and other states have similar high fees. So it's really taking a look at what is the cost associated. I tend to say we're sort of the second opinion on legal entities, because the attorneys will give you kind of their recommendation, and then we always try to be involved in that conversation with the client, so we can chime in and say, okay, well, that sounds really amazing, and here's the cost associated. You're going to pay me to do a tax return, you're going to pay the franchise tax board all these fees every year, and so then the investor can make a really well-informed decision, right? Like, maybe this is the best, and then here's the cost, and maybe we do something in the middle that makes the most sense based on their risk tolerance level, based on what their net worth is, based on how much equity is in each of the properties. So I think a lot of times it's not just like, oh, the structure for one property versus 10 properties may not be all that different. It's just looking holistically at what all they have going on.
Yeah, that's such a great answer. It's not a one size fits all. What do you kind of give as like a rule of thumb with that on the accounting side, or maybe you don't, everyone is different. But do you say like at this certain number of properties, you definitely need the best entity structure set up with a series LLC, or in some cases, they're putting them in trusts, series trusts. But what do you guys kind of see as like a rule of thumb there on the accounting side, not the legal side? Because the legal side will tell you put everything in an entity.
I think I just default back to whatever the investor's attorney recommends, right? Because at the end of the day, if someone were to get sued, their attorney is going to be the one to represent them. Accounting wise, we try to follow, or sometimes we have to follow what the legal side is. So for example, if we have a taxpayer with an entity where it needs a partnership tax return, then we have to do accounting a certain way, because we have to report the profit and loss, we have to report a balance sheet, and those are the must-haves. So the accounting has to sort of match what the needs are. Versus maybe you have a rental that's owned in a single member LLC that you own 100%. If we're going to put on your personal return, then maybe I don't have to do as diligent of recording on the balance sheet, because I don't have to report those numbers anywhere, right? So that's where the interplay is between like accounting and legal on the entity side.
And, but having said that too, I think it's worth mentioning, because I think this is a misunderstood thing too, is that a lot of people think they need to have a legal entity to take tax deductions for certain expenses. And that's probably the farthest thing from the truth. So, you have a rental property, the expenses you can deduct are going to be the same whether you own that in your personal name, put on your personal return, versus if you own it in an LLC or you own it in a partnership and you file a separate return. The expenses are all going to be the same. So really, that's where it kind of comes down to making sure you understand and follow the advice of your asset protection attorneys.
Yeah, that's such a good point.
I love that you were talking about how Hemlane is able to help, with tracking of expenses, where you can just do it on your phone right away. Because I think that is something we always try to tell our clients. Clients always ask, like, what's the best app or software to track expenses? And what we always tell them is, it's not about what we like, it's about what you like. So you need to find a system, a systemized solution where you're able to use it comfortably and frequently. So if it's something on your app you can do right away, the odds of you doing it are much higher than if you have to log in somewhere into the cloud, forgot your password, and then it's like 3 months later before you actually, remember, like you said, who did you have dinner with? What did you guys talk about? So the timeliness of it is so important too.
Yeah. No, it's such a good point of, it saves you so much time if you can do it right then and there on the spot. And then you look at it and you said, oh, wow, all of this can be deducted, right? As rental losses. Speaking of rental losses, can rental losses offset your W-2 income for tax purposes?
Yeah, they can in the right situations for sure. I mean, it doesn't, there's a couple things come to mind. If people are making, there's a threshold of people make $100,000 or less, single or married, they can usually deduct up to $25,000 of rental losses against their income. That can have a huge impact on somebody making $100,000, obviously. If they're making more than $150,000, if it's long-term rentals, probably someone's going to need to qualify as a real estate professional to use those losses to offset their W-2 income. But I mean, there's so many things at play, right? I mean, I think people, forget that sometimes those rental losses that, oh, maybe I'm not offsetting my W-2 income, but you might be offsetting something else. You might have received $20,000 of cash flow from that investment, and now you're not paying any taxes on it. People kind of forget about those things sometimes. Those are the other benefits, definitely worth mentioning.
Yeah, totally. You just mentioned real estate professional status, Matt. Tell me more about that.
So real estate professional status basically is a way that allows higher income earners, so someone who makes over $150,000, to be able to use rental losses against non-rental income, so other business income. So like a common scenario we see would be, let's say you're a high income earner and you're married to someone who could be a real estate professional. In those scenarios, maybe you can create strategically a bunch of rental losses through write-offs and depreciation, and be able to use that loss to offset the rental income as well as taxes from the working spouse's W-2. I think a common misconception people think when they hear real estate professional is we tend to think like, oh, that means I'm just going to be licensed in real estate and become a realtor or a broker. But the reality is that's not what the IRS looks for. The real estate professional really comes down to a set of activities and tasks that you do on a year-to-year basis. And so, one of the main rules to being a real estate professional is you have to have at least 750 hours in real estate. So that could be you being a landlord, that could be you being a realtor or a property manager. You have to have at least 750 hours. And then the second rule, which is probably harder for a lot of people to overcome, is that you have to have more hours in real estate than your job. And so for someone, if you're a married couple, you both work full time in the tech industry, it's almost impossible for one of you to have more than let's say 2,000 hours in real estate, unless you have a lot of real estate properties. And so for that reason, usually when we talk about real estate professional offsetting high income, what we typically see is like maybe a married couple, which, one person is working full time, the other is doing real estate, or just an individual whose job or business is in the real estate industry. So like a real estate broker who also owns rental properties, those are ideal profiles for someone qualifying for real estate professional status.
Yeah, we have a shared client, Letty, who uses both you for accounting and Hemlane for property management. And I know from that perspective, she's a huge fan and teaches all of their students about real estate professional status because I do think when listeners out there are thinking about passive income, and one a person from the couple staying at home and potentially being able to manage the real estate or think about getting that passive income and continuously purchasing property after property every year and having some targets in mind, it really helps for them to know what that real estate professional status is and that they can do that. And I think there's a misconception that you cannot get that status or that you have to have a property manager if you're out of state, and that's not necessarily true. You can qualify for that and you don't even need a license in real estate to do it. It's more of just how many hours are you spending on your real estate investment. Quick question, you had mentioned 750 hours, right? What about like hours to do the rehabs of a property or hours to work on turnover coordination? Is that all of that included in there?
Yeah, if you're kind of you're somebody who's, I guess handy, right? Like maybe and you're gonna do some of the rehab yourself, that those hours should definitely count. If you have to manage the rehab process, manage the subs, manage whatever, those hours should count. The turnover time that you're spending, going and cleaning the property, fixing it up, kind of managing that process, that all should count for that as well. Yeah.
Yeah, and I think there, like you said, there's a misconception too. I mean, especially for a lot of our clients in California or New York, right? Just expensive states, we'll call them that, where people think like, well, to be a real estate professional, I really have to buy something local, right? Where I can like get hands-on hours. But the reality is what they're really looking for is the investor being involved in the day-to-day. So we have clients who, let's say, live in California, but invest in Florida. And if they can self-manage those properties using Hemlane or just other ways to self-manage the properties, there's still a lot of things that you have to do as a landlord, to be able to earn those hours. I think it's really important for people to understand that there are ways to self-manage a property without having to fly out to Florida to fix a toilet at midnight. There's things that
Yeah.
can be done to accomplish both goals.
Yeah, I always say remote management still requires boots on the ground. You physically still need people there who you trust, whether it is someone showing your rental property, like a leasing agent, or your handyman. You need the boots on the ground still, but you can make the decisions from anywhere in the world. So I love that. When does self-managing make sense, or why would it make sense in your case from a tax perspective?
Well, I think, going back to that, talking about real estate professional, right? One of the requirements is that in addition to the 750 hours and the more time in real estate than your other jobs, you need to meet one of the material participation requirements, which more or less means you are self-managing your properties, right? So that's where it's important, is that you don't necessarily need to be doing everything, but you need to, be doing enough of the day-to-day self-management to get the hours that you need to. So now, obviously, if you have 20 properties and you can spread it out and all across 20, that's great. Or if you have 3 properties local and 5 out of state, and the 3 local properties take up 90% of your time, that can work too. But it's probably going to require, at the end of the day, require you to be kind of, is your terminology, right? Boots on the ground to some extent, doing a lot of the stuff.
Yeah.
And I think
Have you,
what I really, oh, go ahead.
no, go for it.
I was going to say what I really love about tax planning is that as the investor, as a property owner, we have so much control over how much or how little we do with respect to each property. So if your strategy is like, hey, I really want to make sure I meet real estate professional status this year, well, you can simply just take on more tasks, right? And outsource fewer tasks to allow yourself to earn the hours. And I know for Hemlane, it's like, well, you can also change. Like, I want, you to help me do more, or you to help me do less. And that could change during the year, from year to year. And so that's where the planning and the fun comes in. It's like, okay, well, maybe this year we have a huge income. We got a couple properties. I want to take on more tasks of the management side. And then next year, maybe I don't have a rental loss because I've already used it in the first year. Then maybe I want to kind of remove some of those duties from me. So it's always like a year by year just designation in terms of how much or how little you do.
Yeah. You've got me thinking so much here because a lot of real estate investors are scared to invest in real estate right now. They may have purchased a couple of properties 4 to 5 years ago, and now they're saying, hey, the returns are not as good. But I always say, or I don't say this. I think this might be a Warren Buffett or a quote from someone like that, where it's like,
You
the
can
best
take
time
you can
to
take credit
invest.
for it. It's fine.
I'll take credit for it. But the best time to invest in real estate was obviously like 10 years ago, yesterday, et cetera. The second best time is now. And so I almost think that getting our listeners in front of Keystone CPA, like your firm, to understand, hey, what could we do? Maybe there's a property that doesn't look that great on the MLS, but you rehab it. There's all of these tax incentives, and suddenly it does look like a great investment. At the end of the day, you get a little bit more creative. Don't get me wrong, it should still cash flow. I don't recommend alligator properties where you're putting more money into it. But for something that may not look as good on paper, suddenly would look better, especially because of the tax incentives associated with owning and operating real estate. Would you agree with that? Like, would you say, yes, absolutely, everyone should still continue to be very bullish on real estate and invest in it? And as long as their pro forma, a conservative pro forma, shows positive cash flow, and then structuring and using these sort of tax incentives can make it an even stronger and better investment. Would you agree with that, or do you think I'm totally off guard here?
Yeah, I think it was it Warren Buffett who said invest when there's blood in the streets or something along those lines. So it's the same thing, right? I think we all know like, oh, that's what you're supposed to do. You're supposed to invest when everyone else is running away, but it's kind of hard to mentally make that shift. But yeah, we have a lot of clients who are, most of our clients are still doing deals in real estate. And I think it's not so much like the market at large, but where like the area where you're investing. There are a lot of areas, even in California, that are still appreciating or could cash flow, right? And so the other question is like, well, how many rental properties do I need to be a real estate professional? Well, as little as one. If you have one rental, like in your example, it's one property, it needs a lot of work. I'm going to create forced appreciation by improving on the property. I get a ton of hours doing it. Make that money in the property and also log more time towards real estate professional status. So there's definitely really great ways to invest, grow your wealth, and save taxes in any market. It's maybe just a little bit of shift of what you're saying. A couple of years ago, anybody can make money in real estate, right? You don't have to do much. It just makes money by itself. Now we just have to put a little bit more work into it.
Yeah, the other thing I was thinking of was more along the lines like maybe somebody who's owned the property for X number of years and it's become more of a forgotten asset, if you will. Maybe it's not performing as well as they want. Maybe they're not spending a lot of time thinking about it. There's definitely ways where people like situations like that where they can, look in strategic ways to unload those properties from a tax perspective and, maybe buy a better performing asset. And there's can be benefits when you dispose of properties. There can be ways to do it if you don't have to pay tax on the gain. So there's lots of things to think about that I think people, forget about and kind of put on autopilot sometimes.
Yeah, no, it's such a good point. And I think that really making sure investors, as an investor, you double down today, I think is really important. And reach out to Keystone if you have questions, right? About, hey, would this be a good investment? What are some things that I could think about with real estate professional status, with rehabs? What can I write off? What can I not write off? I think all of that is super important. Thank you so much, Matt and Amanda. For next steps, I want to do a lightning round with you. Are you ready for it? 3 questions.
I know.
Biggest mistake you made in your real estate investing career?
Oh man, do we have the same one? Okay,
You can go.
I'll do mine first. So years ago, when we first started getting into real estate investing, we joined a group of real estate investors. We met somebody who we really liked, thought he was like this amazing guy, and he was doing his first syndication deal. And because we liked the guy, we said, let's invest our money with you. Eventually ended up losing that investment because we liked the guy, but we didn't do any due diligence on the deal itself. Always been shocking for people to hear from CPAs because we're supposed to be the numbers people. So I share that story with clients and I'm like, hey, we make the same mistakes too. So don't make that mistake. You know, you might see somebody on stage talking about, you know, how good they're at real estate, but always do your due diligence on the deal. And don't be, I guess, blinded by, you know, whoever's talking on stage and assume they're amazing.
No, the one I thought of was just, I mean, probably every real estate investor has a story, right? It's like selling a property too soon. You know, we had a rental property that, you know, it had gone up in value. It made sense to sell it at the time. And then, you know, 3 years later, it's like, man, we could have made another $300,000 on that property. It's like, but obviously there's nothing you can do about that. But that's one that stands out in my head for sure.
Yeah, I do love that one. Because when you look at property appreciate over time. What are because we've just quoted Warren Buffett and taken credit for it, quote you live by and why?
A quote I live by and why. I'm gonna say happy wife, happy life. I think that's a good quote from Matt. No, but I mean, I do like that. I don't know if I live by it. I think that's a quote that sticks with me a lot. Not so much.
I'm the one who's supposed to live by that, am I?
Yeah, but not so much in terms of like really just happy wife, but I think it's so important. Like a variation of it is just to have a really good family life or home life. Because I feel like when things are going well at home and in the family, it makes everything else better. You know, like in terms of it makes your investing better and easier. It makes your job or your business better and easier. So I feel like that's kind of the foundation of it. So I don't know if there's a variation, but maybe not exactly happy wife, maybe happy husband, happy life.
Besides that one, obviously, the other one I think I can think of is like, just keep it simple. You know, we deal with a lot of clients, taxpayers, and attorneys, and there's a lot of times when there's a lot of really complicated structures offered to taxpayers that might work for, we'll pick on Warren Buffett again, you know, might work for Warren Buffett that, you know, 99% of the other people don't need. And you know, it's so to my situation, it's like, let's keep it simple. Like, what do you understand? What makes sense in your situation? Let's not overcomplicate things.
I love that one. And final question, when and where are you investing next?
I guess we'll answer this together.
See how she answers my questions for me?
Great.
I mean, or do you want to answer?
Yes.
So I mean, lately we've been investing more. Well, we've been investing mostly in out of state, meaning outside of California in the last couple years. So probably continue to do that. A lot of our portfolio is in Vegas and as well as Florida. So next, I don't really know. We don't really have a specific plan in terms of when the next property is going to be. We're always looking at real estate. We're always talking about real estate, but I know it's going to be something out of state, probably either in Vegas or Florida. Those tend to be our two states that we're involved right now. But yeah, I didn't know specific timeline. Although the other day we were just talking about it's probably about time we pick up another property. Open timeline.
All right. I don't know. Yeah, for me, I think we've also invested in syndication. Obviously, we spend a lot of time, you know, reinvesting our business and growing our business. And so real estate is not, you know, it's more passive for us, obviously, but we do invest in syndications. And I think I don't think we have any in the self-storage space, but that does seem like one that keeps calling to us over time. So I think that might be something that we look into next time.
Yeah, great. Well, thank you so much for being on the show today. One of the things that really stuck with me was what you said about the biggest mistakes, because I think there's a lot of times you see people on stage who sell you a dream of buy a property with me or I can help you, and it doesn't go to plan. And one thing I admire most about you is back channeling. You guys really have helped your clients significantly. What you say is what you actually do. And Keystone is, from an accounting perspective, incredibly reputable and someone who is in the Hemlane community and family. So thank you so much for being on the show today. And for our listeners, We would love for you to go to their website for some free resources, everything from real estate professional status to any sort of tax incentives and write-offs you can get. Amanda and Matt, if our listeners want to learn more about Keystone CPA, where do they go?
Well, our website is keystonecpa.com. Like Matt said, keep it simple, keystonecpa.com. And yeah, like you said, we have a lot of great free resources that you can utilize. And we also try to do, keep people updated on potential tax changes. I'm also typically found on Instagram as Amanda Hahn CPA. And I try to post there daily for those of you who really don't want to have an hour of tax stuff, but maybe, short tidbits every single day. That's a good place to follow me just for updated content.
And if you don't find me on Instagram, that's because I'm the one recording her videos. So
I love it. Well, thank you so much for being on the Hemlane Hustle. We learned so much today and hope our listeners can purchase their next property and get creative, especially as there are those tax incentives.
Yeah, thanks for having us.
thanks, Dana.